Welcome all to this webinar on transfer pricing developments in Germany. My name is Nacht Donders and I'm the moderator of today's webinar. During this webinar, we will focus on some new items that are recently published in the new German draft law, and we will make a comparison to the Netherlands and the OECD guidance. As Germany is often considered as a challenging country with respect to transfer pricing in practice, I'm happy that I'm not alone in this webinar, but have my German colleagues on the line, as well as my colleague Theo Elsoff, who also has much experience in intercompany transactions in Germany. I would now hand it over to Theo, who will further introduce you to this topic.
Okay, thank you all for joining this webinar. It is great to have you here and also with our fine Dutch partners in Germany. And Germany for me was always very interesting location. As southern of the Netherlands, I speak German and did a lot of the audits and APAs in Germany in former years, and therefore I have a specific interest and feeling about it. And it's very nice that we can have our partners of TPNC from Oliver Treidel and Tom Koens, who will be able to speak you through the German new setup there. And I'm very interested to see what the comparison is between the German status at the moment with the new setup and with comparison with the Dutch one. Before I go to the index, I would like to give Oliver and Tom the floor to be able to introduce themselves. And maybe Oliver, you can start.
Sure. Yeah. First of all, thanks for the kind words, and I always enjoyed my time in Eindhoven, so I can give this back. I'm Oliver. I'm an economist based in Berlin. Do nothing but transfer pricing all day long, which I thoroughly enjoy. And I think, yeah, what we're trying to do today is to give the audience a flavor of how transfer pricing works in practice in Germany. And I think what Quantera or what I enjoy about working with Quantera is that we share this, yeah, let's say pragmatic and solution focused approach. And then, yeah, let's try to get it on the road. Thanks for having us.
And
Tom, of course.
Yeah. Yeah. Hello and welcome to here everyone from my side as well. I'm Tom and I'm a transfer pricing consultant at TPNC in Berlin. I think I met Oliver like 3 years ago, and yeah, continuously working with him in transfer pricing, pretty much enjoying it. And yeah, thanks for having us, Theo and Nart.
It was a pleasure. And Nart is the one who's the moderator, trying to pick all the pieces together. And Nart?
Yes, thank you, Theo. So my name is Nart. I'm a junior transfer pricing manager at Quantera Global in the Netherlands. And also in the last couple of years, I worked together with Theo and Oliver on some interesting German projects. So I'm happy to be here today in this session.
Yeah, and it's a great time to be able to show our alliances, and I think with Oliver and Thomas, one of our closest people we work with, and as we have the same DNA, problem solution orientated, and listening to clients, but also to defend them against what's happening in the environment at this moment, and that is also in the Netherlands a little bit happening at the moment. A lot of the newspaper, and I'm very interested how this on the floor is happening, because it's not only legislation and guidance, but this how is it handled by the authorities. And you will do it to an index, to an agenda. First, I will ask what's new, make the joke that Bayern München every time gets the title, but what's new in Germany. Then we get the interpretation in Germany on the arm's length principle. We will go into a new chapter of TP, which with the latest report of the OECD on intercompany financing. An interesting topic always with Germany is relocation of functions, mit Funktionsverlagerung. And I think we will end with some big pictures and reading between the lines. And therefore, my question, Oliver, what's new in Germany? Yeah.
Yeah, I think what's new or maybe old is that the German authorities or tax authorities are quite busy in thinking about how to, yeah, let's say, keep more money in Germany. And in the field of transfer pricing, I think one way one area they are investigating here is transfer pricing and kind of, let's say, tightening the reins here on the on the regulations that have to be observed by the taxpayer. And one issue that is on our agenda today is to take a look at the, let's say, 100+ pages of draft law that was published in December 19, and kind of try to walk you through some of the highlights there, and try to discuss what are the implications from a taxpayer's perspective. I think just maybe to give you some context or some flavor of the mindset maybe that was applied by the authorities, it's worth noting that they published the draft, I think to be exact, it's 109 pages, and they gave the general public 3 days to submit comments. So I'm not so sure if that's kind of really a kind invitation of practitioners or taxpayers to take a seat at the table, or if it's appropriate to interpret it as a, let's say, rather hostile and unfriendly way to go about the business. And I think when we look closer now in the next hour, we see some of the regulations that are really, it's hard to find a milder term than calling it a bit taxpayer unfriendly. And yeah, so that's what we're trying to do today. Address the issues that are listed here. So some general remarks on what the German view on, or the German how they handle the arm's length principle, and I'm sure we can discuss some of the let's say idiosyncrasies in Germany compared to Netherlands. And then I think the two biggest issues are really intercompany financing and relocation of functions. And we touch on some other stuff as well. Of course, if any questions arise throughout our dialogue or presentation, then we can always address them any appropriate time once we're concluded.
Okay, because maybe a remark, you can put your questions in the chat box. So please do, and we will take this very serious in. Yeah, okay.
Yeah. So maybe so now I started off by already kind of emphasizing that the development may not be all that taxpayer friendly, but so let's before we address these more critical issues, maybe have some more positive and kind words to what is happening. So what is really positive about the new draft law is it's more, let's say, readable. They changed the structuring, which is good if you want to take a look at the regulations and find your way about them. I think they are much more readable. So I'm not sure if that's a huge compliment. So yeah, the authorities obviously did some of the homework in terms of writing the stuff down, but looking at what is positive from the more substantial changes, I think is what is listed here first. It does reflect an overall alignment to what we see on the OECD level. So the OECD guidelines were revamped in 2017, and I think generally speaking, we can say that the German authorities followed most of the guidance in respect to putting a stronger focus on economic substance and functional and risk analysis. So I'd say that's really a big positive, I dare say. One issue where this is reflected is that Germany used to have, or still does, as the law is still in effect now, a hierarchy of methods. So you're really supposed to start your transfer pricing by looking whether or not you have a CUP, so comparable uncontrolled method, or another standard method like resale price or cost plus. And TNMM and profit split, but especially TNMM are always treated as second class methods. That goes for the written law up till now, which is changed, but it also goes to how the tax auditors kind of view the methods. And one thing to know about Germany, transfer pricing in Germany, is that this attitude towards the TNMM, which a lot of clients use, taxpayers use for outcome testing purposes, is really one great skepticism. So you encounter a lot of German auditors who focus on this price setting approach, and they really do not favor documentations that are solely based on a benchmark, or whether benchmark or TNMM benchmark is very much in front and center of the documentation, and little else in terms of context is provided. So while it is, I think, certainly positive that Germany says, okay, TNMM has its uses, it's credible, you can use it, it's not a second-rate method, so we should not kind of be too optimistic about it in terms of that the general attitude will certainly not go away overnight. So when you use TNMM in Germany, still you might be well advised to be a bit more careful compared to maybe even the Netherlands or the US for sure. You have to be very detailed and consistent in outlining the classification of your tested party. So it's not in Germany sufficient to just say, okay, we have the tested party, end of story. In Germany, you have to really put the label routine entity on this tested party. It has to be a routine entity, a routine Unternehmen. Otherwise, it's still not permitted to use the TNMM method. So you have to have a routine entity in order to apply TNMM to start with. In Germany, as you might know, Theo, we have 3 categories. So there's the entrepreneur and the routine entity, which you're all familiar with. But in the middle of this, let's say, spectrum, there's something called a hybrid entity. And when you apply TNMM, you must make sure that you're not kind of classified as a hybrid, but really as a routine entity. So that's one of the German, I think, specialties you have to be aware of here.
Yeah, I think, may I have a question there? I think that's I think for a lot of people maybe an eye opener that you have those three brackets of companies, because I had a lot of discussion about where I was on the TNM and the auditor was on the CUP, and I didn't, in the beginning, didn't understand the discussion, because in my head it was a routine entity.
Yeah.
But that was, and I tried to explain it, but then you got for the auditor in a sort of hybrid way of discussions, and that took a long time the first time. So we have to be very careful to go into Germany with your entrepreneur and routine entity approach, the residual approach, as we call it.
Yeah.
That's difficult, but that stays in the Germany. I think that the law will not change it, because you can be still in that hybrid bracket.
Yeah, so that will remain valid. So you have to treat careful. You have to have a very solid functional risk analysis, and then based on the functional risk analysis, you have to do this classification of the entity, and you have to make sure it's a routine entity. There's no way around it. And that's the challenge when you come in from the US or UK or the Netherlands, and you have basically a system that is more outcome tested oriented to opposed to this German price setting idea that is not looking as favorable on the TNMM. So that's just one thing to keep in mind. So do not take this, even though it's positive that we abolished the formal hierarchy of the methods now, or we're moving towards that. You should not be under the illusion that the German taxpayers will just all of a sudden embrace TNMM. So I think that's a fair statement, and I'm going to follow it up on the last slide of the presentation, although the second to last, where I have a book review, some very small book review for you guys. But maybe just to move along here, the skeptical attitude towards TNMM is also now kind of even getting more serious, if you will, when you look at the discussion on the interquartile concept. Up to now, so right now in Germany, you have to narrow the arm's length range, but you are under no legal obligation to apply interquartile range. So you can adopt a much more flexible approach, which I enjoy in day-to-day practice, because obviously if you're not bound to the interquartile range, you can have more creativity in outlining like target margin systems. And it does work, and you can defend it, but the draft law we are discussing now is making a provision that you should more or less by default apply the interquartile range. And if you would not go along with this, the burden of proof would be falling on your shoulders to argue why in your specific case the interquartile range is not applicable. So this is certainly a negative, in my view, a negative development, because it curtails taxpayers' flexibility in actually implementing target range systems. But yeah.
But it's still close to the Netherlands, because in the Netherlands we have also that range in the quartile range. And if you look at the most recent transfer degree of the Netherlands, so it is not law, it is a degree. Then they say also when you are outside that range, then you have to, it's not the burden of proof, but you have to be able to explain why you are outside the range. And when you're within the range, then there should be no adjustment. Yeah. And what I see in the Netherlands is that the Dutch tax authorities are looking in it as when you're outside the range, that they do an adjustment. That may be like Germany, that you almost have the burden of proof, and that will be very difficult to get into. Yeah. So I think here we are close in the way we are looking at it at the moment. If this is then acceptable.
If it's accepted, and one thing here, and that's why we in the first slide also emphasize that there's a draft in December and one in March, because as I kind of try to allude a little bit in the beginning, the time for comments was very short, but there was quite some outcry in Germany from some of the like business federations addressing some of the more critical issues here, and one issue also was the wording of various of the changes, and this also relates to this interquartile concept, but it was more or less a running theme throughout the tax law draft. In a lot of cases, the wording applied by the Ministry of Finance was one that the taxpayer all of a sudden has to prove that they are right, and not just showing plausibility or something. And they kind of toned it down, like I could assume, like based on the pushback they got, they realized they may have taken it a step too far in some of the cases, and so the draft version as of March has a lot of cases where a lot of wording where you find, okay, you just have to show plausibility, and you're not under, let's say, the unrealistic assumption that you have to prove something. So I think that's this is at least something, but again, in day-to-day practice, even showing plausibility might not always be that easy. Okay, so I think that's that would be my remarks for like the general interpretation here for the arm's length principle. Mm-hmm. Maybe follow it up with some comments on, because you said in the beginning it's a tough, Germany is perceived, and I'm not sure, it's a tough location for TP. I would agree to some extent, but I would say on paper we are not that tough. So if you just read the letter of what is happening here, especially with the toned down wording I just outlined, you might get the impression that, well, Germany might not be that tough. And yeah, there are some positive aspects in terms of more focus on economic substance, but do not underestimate the, let's say, informal requirements that come up during a tax audit. And I'm not sure how it is in the Netherlands, but in Germany, I mean, obviously, we prepare a transfer pricing documentation, submit it, and that should be the basis then for the audit. But we see it like in almost every case that the auditor comes back with a rather long list of additional questions, and he's asking a lot of details in terms of seeing your business planning data, cost plans, cost calculations, and so on and so forth. So it can be quite burdensome and detailed in terms of documentation requirements that you might not immediately see from the requirements of a master or local file concept. So that is definitely something what makes Germany a not so easy country.
Yeah, what you see in the Netherlands is that they still rigidly say nice paper, but tell me what you're doing. They look at the economic substance. What you see in the last year, more and more that it seems that they are more aggressive. and asking more questions like in Germany. So it seems that we are, from the how the audits are done, we are going to be more aggressive than in the past. And but like the focus on economic substance was always there in the Netherlands. I think when I worked with the Dutch tax authorities around 2000, 2007, we were seen as the Netherlands was seen as economic substance country or position, and therefore when we saw the new guidelines and the BEPS papers, we saw a lot of our original wording in that plans and reporting and guidelines. So that is the same. That we never change, I think. But what I see that we are going to get more detailed questions like you in Germany. So the audits are a little bit more aggressive and sometimes too quick with a lot of perception. I think that's also what I see in Germany.
Yeah.
That an auditor comes in with his caps and his thoughts about how it should be from price setting, and then don't take the time to get into all your stuff like functional analysis and your defense.
No, that's exactly the point. Yeah, I mean, you do go through a lot of effort usually to prepare transfer pricing documentation, and you prepare a very systematic approach in outlining the transfer pricing system. And what we see happening is tax auditors really focusing on, let's say, minor details and kind of blow them out of proportion, right? Looking at some cost accounting and ask you questions about a single account, which in the scheme of things really is not that important, but they try to just find any inconsistency. So that's sometimes a little, I do not think it's proportionate most of the time. And you can definitely, when you are in the middle of the tax audit, also make this point to an auditor, at least if he really pushes it too far, to say to him like, look, in posing your questions, you have to observe the principle of proportionality, and please start by first reading the documentation and then base your assessment on that. And if there are any questions open, we're happy to answer them, but let's try to keep the audit proceedings concise. So you're within your rights to do this, but maybe a lot of taxpayers are a little cautious to adopt such a confrontational approach, but sometimes it's the right approach to take, especially with, let's say, a little aggressive German tax auditors. You have to sometimes let them know that there's a limit to what is acceptable. And to be honest, what kind of bugs me through the last years is that I really do not like sticking with the proportionality argument here. I really do not think that these types of audits are really tackling the core of what we see with the base erosion arguments here, right? And one manifestation, and that's the last bullet on this slide, which kind of ties in here, is that the German guys are really reluctant to accept year-end adjustments, or they're very critical of year-end adjustments if you're not having a very, very detailed or like very streamlined method explained in a contract, ideally, on how you calculate these year-end adjustments. So you can adhere to the European Joint Transfer Pricing Forum guideline, but a German auditor will always challenge you, even here, when it fits its purposes, on formal grounds. So you would have to provide very detailed calculations and contracts to show that those year-end adjustments you conducted were agreed before they were done. So again, this price setting idea outweighing this outcome testing logic.
Oliver, we received 2 questions from participants, and I think one of them really aligns with this point here on adjustments. So the question is, can you make DP adjustments in Germany if your initial result is already in the arm's length range? So, for example, from the lower quartile to the median, is that accepted in Germany? Like
a proactive basis, it would be, let's say, it would be strange. So to make an adjustment within the range, I think is when you're already arm's length, there's no cause to do an adjustment. Obviously, if you have a target margin system and you have based the target margin system on a benchmark, and you opt, like, proactively as a taxpayer to apply a target margin that is smaller than the interquartile range, which, well, you may do, but it's let's say unconventional, then again, if you have explained this proactively and before you do the adjustment, then you could operate with adjustments within the range, I'd say, but it's really not what we see happening.
Yeah.
Okay.
Yeah, and another question is then whether we talk a lot about the interquartile range on the previous slide, and someone is asking the question whether the Corona crisis had an impact on the acceptance of the interquartile range concept.
Well, it's really too early to tell, right? Because those cases haven't hit the audits yet. But let's say here that I would be reasonably optimistic that if you have arguments, and I mean nobody would doubt that Corona will have an impact on the financial ratios of the comparables. You can obviously work with this and maybe go even below the lower quartile, but from what I'm hearing or what I've been reading, so they will take a sensible approach. But again, being in Germany, you would be well advised to document your reasons to do so. So in other words, you would have to explain that you or your tested party in that case is really affected by the Corona crisis. So just doing it without explaining it or without clarifying the link to Corona is probably a little shaky.
The main message what I'm hearing also in the Netherlands is that Corona in itself is not a reason to go below the interquartile range.
Yeah.
We have to really document why third parties would be willing to.
Yeah.
And that's for me the reason that I'm looking at the moment is what's happening in the markets and what people accept within third parties. But I think that's a good advice to do. One small question, I think, but for time's sake, small. Germany always was seen as you have to have formal agreements. Without in the formal agreements, there's no deductibility in Germany.
Yeah.
I think that's although it is more economic substance, that's still the case. Those year-end adjustments, I think you should also include them in an agreement. So otherwise, maybe you have a problem if you are not. It's not in. Just as a remark.
That's true. I mean, the textbook example for this was the cost allocation. So if you don't have a cost allocation agreement and you have centralized costs that you allocate, usually the German tax auditors would challenge this very harshly only because you don't have a formal agreement. And if it fits their purposes, they are certainly going to attack you and it's not going to weigh in your favor. So yeah, being in Germany, it's just it's advisable to have contracts for what you do. They don't have to necessarily be very comprehensive or very detailed, but you should have some contractual basis in place. Yeah,
that's obvious. Okay, thank you. Yeah. I think Oliver, now we're coming to a very new chapter, and maybe before you start in the company finance, it was always since 20 years a discussion in the Netherlands how to include transfer pricing guidelines into the finance area below the EBIT line, and we looked at that time at captive insurance, etc. What has a lot to do with risks and ratings, like here, and to be honest, that's a new OECD report. Last year was for the Netherlands also a stepping stone to go into the finance area. So I'm very interested how the German approach is now.
Yeah, I think this is the chapter that was arguably most controversial here in the discussions, because here the German draft law, as you can see, if it's published in December 19, it predates the OECD Chapter 10, right? So as you can see, Germany is really being the eager beaver here and trying to be even quicker here than what is happening on the international area. And the really bothersome aspect here is that the German interpretation is here, although I said in general terms we're going closer to what the OECD does. Here we're really seeing some very peculiar German interpretation of what should happen, and what is really maybe that is most clearly shown on two aspects here, and the first one is that when you read through the German draft law, they make it very clear that you would, in the first step, have to prove two things in order to have the intercompany loan accepted as such for tax or transfer pricing purposes. So the borrower would have to show, or you have to make, again, a plausible documentation that the borrower is capable to fulfill debt service for the entire duration of the loan, and the loan must be commercially needed for the borrower's purposes. So I think you can, if you look at Chapter 10 of the OECD Financial Transaction Guidelines, you can see similar notions, but they are in no way worded in such a strict fashion than they are in the German draft law. So the German draft law is very, very keen on clarifying that if you're not really providing a lot of details here, or very conclusive documentation, that they will not accept the commercial validity of the loan. And once you have the first step covered, then still and I guess that's really where it shows that it's a draft law that is motivated by very defensive spirit here from the auditors. They say, okay, look, the interest rate can be no higher, or should be not higher than that achieved by the group as a whole with third parties, meaning your headquarter rating or the group rating should really be the focal point of your interest rate analysis. So, and we have this discussion, and of course internationally, and you can explain the Dutch perspective maybe, and I know the same holds true for the US. Is that basically you would go and much more focus on the standalone rating and try to apply rating tools and such, and do benchmark analysis in order to determine an arm's length interest rate for the borrower. And of course that is done in Germany right now as well, but the draft law makes it very clear that the tax auditors take, or tax authorities in general, take a very critical stance on those kinds of analysis, because they feel, and it's really, I think the wording "feel" is appropriate here. There's no, in what I see, there's no empiric basis for this, but they really feel that the standalone ratings that they see coming out of those rating tools from Moody's and whoever is kind of geared in the way that the German borrower is pushed into a non-investment grade rating, and that they consider this abusive, or they seem to have the feeling that they are sort of defenseless against these sort of practices, which I mean, for obvious reasons, I cannot share these feelings, but I think one has to understand what the feeling is in order to appreciate what is written in the law here.
Yeah, it's like if the German tax authority, German is afraid of the databases, like the TNMM database. They have the same now against this kind of databases. And maybe, Nat, you're part of the finance team. Can you give some remarks on this slide?
Yeah, indeed, Theo. I think what really triggers me is indeed the difference between the approach for determining the credit rating and use the credit rating in the benchmark study. Because what we see in practice is that the credit rating has, let's say, maybe the most important factor for determining that the interest rate, the arm's length interest rate. So what you see in the OECD guidelines, and also what the approach in the Netherlands is that you look at the creditworthiness of the borrower, and that's your starting point, and the credit rating of that borrower. And of course, depending on that, on the importance of the company relative to the group, you can nudge it up so that it can come closer to that group rating, or it can be the group rating, really depending on the strategy of the company.
Yeah.
But the starting point is different. So if you don't have that implicit effect, then you can have different approaches in the country of the lender and the country of the borrower, which actually can lead to disputes and in the worst case to, I think, double taxation.
Yeah.
So I think that's the major risk here.
And
okay, maybe
I share
Oliver.
this concern. Yeah, I absolutely share this concern, and I mean, I think this position or the skepticism towards exactly to what you outlined, Nard, is widespread in German business, from the German business side as well, and they more or less demanded that this be scrapped. But I have the feeling that I dare even say, irrespective of the, let's say, future as a law here, again, the mindset here is clear. And when you encounter a tax auditor, even now, and you have a intercompany finance system in place that is based on standalone ratings, or even if you have a down notching procedure, so not up notching, but down notching, which might be a little closer to the German preference here, you be very well advised to explain why the approach you adopt here, the down notching procedure, is indeed arm's length. My reading of the OECD guidelines is 100% that down notching or the approaches that you outlined are 100% commensurate with arm's length in the international reading. Obviously, if you read Chapter 10 of OECD, they are not like advocating that you can just apply a rating tool and be carefree. Even though OECD says, okay, you have to exercise appropriate care, but we do so anyway, right? So, and I think the German authority here is really going a step too far. But there's no other way to put it.
Yeah, there's also some interesting questions coming on this item. For example, we are now talking about the group rating, and I think it is a bit focused on that the borrower is in Germany, but what if the lender is located in Germany? Do you then still have that approach that you would apply the group rating, or is it then less strict from a German perspective?
Obviously, that's a valid question. Yeah, in theory, of course, it should cut both ways, right? But I mean, as you know, I mean, if a German tax auditor will obviously, and let's be very let's be very candid here and very clear. The approach here is clearly directed against financial holdings located in Ireland and in the Netherlands and elsewhere, right? So that is where the German tax auditors look here, and any outbound cases they are obviously not that concerned with, and they would likely accept it, but it's clearly directed at those kinds of transactions. Plus, maybe to further make this very clear where they come from in connection with this financial holdings and centralized corporate tax function, let's say. Also the draft law, I mean, you see in the OECD, they say, okay, look, the cash pool holder, you have to make a functional risk analysis to determine, is it really a service? Do you get a cost plus 5 remuneration, or does the cash pool leader share in the synergies, right? Again, if you look at Germany's draft law, I think it's a very similar logic here. They say, no, it's a routine service. That's the default assumption. If you think elsewise, you better well go out and prove it to us. And if you cannot prove it, again, the cash pool holder is in the eyes of the German tax auditor only entitled to a routine remuneration or a risk-free return. So all those centralized financing structures are certainly under intense scrutiny from the auditors. I think that's the takeaway here. So if you have a centralized financing structure which is based on standalone ratings and where you have synergies at the cash pool leader level, then you might experience some difficulties to get those sort of structures through a German tax audit. Yeah.
Okay. May I have another question? I think the delineation of the transaction is really if in fact is a loan or equity, and then the first capable to fulfill debt service for the entire duration. I think we when we do such a setting and then or the documentation, you do it from the start from the loan. At that moment, you determine if the borrowing capacity of the borrower is in line with the party comparison, and that stands for entire duration. Maybe it is semantics and it's not meant. But does it mean that you have to look each year, or if it is still the case, or because it seems to say it? I don't know.
At least that's also my understanding, that it's meant in this way. So it's also I think important in those scenarios to think about scenarios where you may not pay interest for certain period of time, and if you elect for very valid commercial reasons, again, you better explain it and explain why you're not paying. And if it's determined that you're really not capable of servicing the loan, then again, the question is, from the German tax authorities' perspective, is it still appropriately characterized as a loan, or if third parties at that point in time would cancel the loan or whatever, right?
So, but this may be semantic, because in the Netherlands, if it is not, if you can't pay it after 5 years, you also have to look at the leverage again, if it's still arm's length. But
for sure.
But here it is more in your law, and then that's something different. Okay, seems more stringent, more severe than in the Netherlands, where you have to look at the leverage, but that's because it has to stay arm's length somehow. But if it is a loan that is more or less defined at the moment you grant a loan or obtain a loan in the Netherlands. Okay.
Yeah.
Okay.
And also maybe from a practical perspective, is this more, let's say, the more restrictive approach we are discussing now, is that, or do you also apply that to the existing loans? That's all, or is that only applicable to new loans that will come when the draft law is implemented?
No, that would only come once it's implemented. So the status quo is, I would go along with the let's say, analytical framework you outlined. So if you have a rating in place based on a commercial rating tool, I'd be willing to use that and defend it. But what you have, so you don't have to change it proactively, but you would have to be aware that when the audit comes, you better make an effort to explain, let's say, the input factors that you use to calculate the rating as much as you're possible. I mean, that's a difficult part, right? Because those calculation tools are admittedly somewhat of a black box. They're not arbitrary, but you should have you should be able to explain your rationale also for up notching or down notching. So rationalize and provide an explanation why you feel it's arm's length for a certain borrower to apply, let's say, a down notching of 3 notches as opposed to 1 notch or something like that. So
okay. And maybe last question from my side. In the Netherlands, we have on the capacity of borrowing capacity, we have something like triple B minus, that you said is investment grade. From if you go below, then it's non-investment grade, and then you could have a discussion: is it still a loan? Is something of that guidance also in Germany when it?
No, luckily not. Luckily not. No.
So you have to defend it from what you have as a more objective in topics or criteria in the market.
Yeah, so there's no, in other words, there's no threshold based on rating scales for that.
Okay. Now we're coming to a very old discussion, at the relocation of functions. That's maybe can you give us a view what it was and what's changed, because I think it is for everybody a very difficult area to enter. We call it Funktionsverlagerung, but I always found it is in the end we solved a lot of cases, but it was not a walk in the park each time.
I mean, that's my experience too. I mean, I've had quite a lot of relocation of function cases over the years, and my experience was exactly like you say it. So you have to be diligent and invest quite some resources in providing the documentation, making the analysis. But if you do so, usually the outcome would be, let's say, okay. So the framework that was put in place, I think in 2008. Was already quite a strict framework, I think, looking internationally. So the German auditor here had quite some leeway in analyzing what was happening in terms of when production or sales functions, R&D functions were moved abroad. And obviously they're looking more at outbound here, outbound transactions. So, and it was in place, quite detailed regulations also with, I think, close to 50 pages or so, with very detailed provisions on how to cope with such cases. And maybe from the day-to-day perspective, one of the most important issues here was and still is, and Tom knows this, we had a case like this last week. You always first have to see whether your restructuring kind of fulfills the criteria for a Funktionsverlagerung, in the sense that you have to make an economic valuation of the so-called transfer package. So when you move for production function to maybe let's say Bulgaria or Romania, for example, you would have to analyze what is actually relocated. So the value added, or the value of the function, is then defined as a package consisting of every tangible and intangible asset that is part of this restructuring. And so obviously evaluating or valuing such a package is very tedious, and there's a lot of uncertainty in terms of how various parameters have to be defined and quantified, and there's quite detailed guidance on the let's say assumptions of the authorities that you have to fulfill in making these calculations. And because they are so tedious and fraught with uncertainty, you would in the first step always ask yourself, do I or can I make use of escape clauses? Can I get away from this? And right now you can get away from this. And if for example, and that's the most important one, if the relocation, so if the company you relocate this production function to is only being active as a contract provider for you, so it's really an outsourcing case, it's again a routine entity, there that we are again at the importance of this concept. So if you can prove that the company that obtains this function is a routine entity and is remunerated on a cost plus, usually like cost plus 5 maybe level, and is performing this service for you, and then you're basically off the hook, right? So end of story, you do not have to make any valuation of a transfer package, and there's no exit tax and such. So that is quite important for day-to-day practice, to have this exit clause being effective. And based on our discussion we had yesterday, I did some research to kind of try to quantify the importance a little bit, and I found some material there, some statistics from the German Ministry of Finance dated from 2015. So they did an assessment of how does this Funktionsverlagerungs regulation work, and in this assessment they determined by making a sample of I think 130 cases or so, that these escape clauses were applied in 50% of the cases. So quite a high number, quite a high importance of these escape clauses there. Mm-hmm. And another important escape clause was when you relocate an immaterial like intangible is part of whatever you relocate, and you can quantify this exact intangible, then you don't have to make this package analysis, but you can, if you have maybe an external valuation from a company there that values this specific intangible, you can actually apply this price, which mm-hmm. also is a great shortcut and the escape clause there. And now what is surprising to me, and I told you this yesterday, I thought this works rather well in practice, and the German auditors are certainly not shy in challenging you, and they are successful in challenging you. Again, I can back this up with some fun facts or statistics. In those 133 cases or so that were investigated, there were 77 cases in which the price for this transfer package was increased by the auditor. That's 60% of the cases, right? So it's like the auditors were well capable of making adjustments if they did not like what they see. And now, as you can see in the slide, what is happening now is they're going to make it even tougher. For whatever reason, I really am at a loss to explain this. There's for me no rationale to do it. And in the first draft, again, talking December 19, they flat out deleted all the escape clauses. And again, I was not the only one apparently who was not very happy with this, and maybe some people with more political clout kind of made this argument to them, and they at least reinstated this escape clause for routine entities. So that was a huge relief. But it also, again, what can be learned from here, or what can be as a takeaway here for taxpayers, is certainly that if you're dealing with such issues, then better be aware that the German tax authorities make this a focal point of their audits, right? So better treat carefully here.
Yeah.
And frankly, I was, even though I was more or less confirming my bias when I found the statistics, I was still kind of shocked by the proportion of cases in which those adjustments were made. And I think the average amount of adjustment was like 4.2 million euros. So it's not pocket change exactly.
No, and what I saw is when you're well prepared, escape clause or documentation, then mostly we got out with no or very limited adjustments. So that's, I think, both sides of the coin. Huh?
Yeah. And here it's really, I mean, in Germany, maybe when we talk about documentation requirements that may be known or not, I mean, Germany, when you talk about local file, or then you do not have to submit it like proactively. You only have to submit it once you get a formal request of the authorities, and you have 60 days to do it. That's okay. That's not very strict, and you don't have to make it contemporaneous documentation. But for relocation of functions, this is different, right? So you have to have a contemporaneous documentation in place anyways, and to be very frank, if you're cutting corners there, or you are not prepared to invest the time to make this contemporaneous documentation on relocation of functions, you are going to run into serious trouble, because then if you do not have this contemporaneous documentation, it's like you cannot claim ignorance, or you cannot go, like when the tax audit happens like 4 or 5 years down the road, you cannot in the proceedings say, I cannot determine anymore what was happening 5 years ago. Colleague Müller or colleague, I don't know, whatever, Van Drongelen, when we talked about him, he's left the company, he cannot no longer explain it. That's not going to cut it, right? So it's not, you have to have the explanations ready.
I mean, not going into the area too much, but also my experience with mutual agreement procedures with Germany was a positive outcome, but it took a year, very long and very detailed questions, and a very long time for getting positions paper from the German tax authorities. You have your specific way of organization to the competent authorities in Germany, from the local countries within Germany, the Länder.
That's true, and I think like when we're talking Germany and the Netherlands, and comparing like how the tax auditors are set up, and you said mutual agreement procedures, but when you look at APAs, for example, I also kind of try to confirm my bias when looking at stats, and I think on the data based on 2017 or so, Germany had like 12 new cases a year, or 20 or something about that area, and I think the Netherlands had 150, and maybe that kind of indicates how proactive and accessible the tax authorities are. I'm just saying. So,
okay, well, that's maybe a topic for another time.
Yeah,
APS rulings. Okay. Maybe last thing, the price adjustment clause of transactions. What strikes me is a 7 years period. I believe it was 10 years in the past in Germany. In the Netherlands, it's 5, but still a long time. And you have a broad range. Maybe you can explain about it, Oliver.
Broad range, I'm not even sure if it's broad. It seems broad when you look at it, right? But it's 20% deviation up or down.
Okay.
So actually, when you're dealing with hard to value intangibles or these transfer pricing packages, 20% is not as much. And we talked about how to cope with this in day-to-day practice. So the default assumption of the German auditor is like when you're dealing in a situation with uncertainty, that third parties would agree to like an adjustment clause in the contract or for the transaction. And again, they used to be 10-year period for this. So what it means is that please redo your calculations in 10 years time based on the input factors you outlined at the time you made the transfer, right? So and if you deviate more than now 20%, then that's indicating that the price is not arm's length, and the third parties would agree to an adjustment payment. And obviously for 10 years, even 7 years is long, so that's not a very nice provision hanging over your head. So the recommendation here is to be very proactive here, and if you have such a transaction, have a clause in your contract ready that has a adjustment mechanism defined that applies a reasonable but yet substantially shorter time frame would be my advice. Maybe something like 2 or 3 years.
Yeah, same, because if you look at the arm's length principle, what third parties do, they never would agree, I think, to a 7 years period, because when you transfer your intangibles to the other one, and after a short period of time, the value depends on what the new buyer is doing with it.
Absolutely.
So we wouldn't accept 7 years or 5 years, but you could stand your position there and bring it back to a realistic period.
Yeah, 100%. That would be very, very much the way to go here.
Yeah, I think the Netherlands is the same. Yeah, same thing. Yeah, okay. And also the 20% is in our degree and on transfer pricing. So there have the same range. Okay. Yeah, maybe next slide. Yeah.
That is the book review I promised you, so really short, but that's written by representatives of the Ministry of Finance. It's not in their official capacity, obviously, but still, it's a nice book. It gives you some information on the legal background in a very accessible form. So it's quite well written, in my opinion. You get access to some of the most important subjects. So if you can speak German, that is, you can read it. It's a bit, let's say, from the side of the maybe lawyers and tax lawyer side, but it's not the most pragmatic book in the world. But it's still, I think, worthwhile to recommend to guys being active in Germany or want to inform about the German transfer pricing situations. But there are some chapters in there, and I'm not necessarily naming names, but one chapter that might be making interesting reading is on the documentation requirements. And here I think you can really get a taste for how overburdening the information requirements can really be if a really hostile tax auditor in Germany comes along. It's scary reading. Sort of kept me up at night. I'm still working on writing a rebuttal on this, because it's really insane stuff in there. And it's also like one of the most worrisome issues there is in this chapter, that it's almost a flat out rejection of databases. Again, it's a private capacity of the specific individual, but yeah, for guys not being active in Germany, that's probably scary reading. You wouldn't believe it's true. So if I don't take my word for it. So if you want to follow up, you can have a look, right?
Like what I perceived in a German audit, they almost want a copy of your total system, including your email system, everything in it, to get a good view of what's happened in the company. Like if all the emails together gives you functional analysis, that's not the case, but that's almost how they perceive it. And
that's the level of trust you are blessed with. Yes.
Crazy. But
maybe we have to work on our image then, but yeah.
I think that's also in the Netherlands happening a bit, that the image on the multinationals, and how we can treat them and invest them is going away. That we could say maybe the point of there will be a point to take a stand that's enough, and that's what's happening in the Netherlands as well. But it's more on perception, like what's now in the newspaper on the effective tax rate coming out of the CBCR. How is that interpreted? Like we are all tax havens in Europe for multinationals. Yeah. Okay.
They would have you believe, yes.
Yeah. But I believe that you also have something in English that you have to.
Yes.
I think it was very easy to find. I believe.
Very
Tom.
easy. Tom will explain this because
Yeah, just to mention the articles we were referring to, and the German Ministry of Finance provides you with almost all important laws and regulations for cross-border transactions in English. Somehow not everyone speaks German, but the issue is, well, first you have to click yourself through the German website to find this link, which, well, is quite difficult even for us. So we took some time to find this website and provide you with the link here. It's a well-hidden treasure, helping you a lot if you want to read up some legal stuff, procedures, but an alternative is still to reach out to us, because as we discussed, what's written in the law and what's happening on the ground might still be, well, a bit different sometimes.
Yeah, and may I add something to it. I think in Germany, there in history, I had a lot of advisors that German advisors. You had the question: are they aggressive enough to defend the taxpayer to the German auditors? And I think that's you don't have to be. You have to respect everybody, but you have to take a standpoint from that you defend the company towards it, and I think that's also an important item. I still maybe say last words on that, Oliver.
I think that's really crucial if you really want to have an efficient audit or efficient documentation process. I mean, you have to keep the proportionality in mind, and I think that's what we're also trying to emphasize all the time. Take a pragmatic approach. Have a very consistent but streamlined transfer pricing system, and even if you have a TNMM system, I mean, you have a clear let's say a storyline in the transfer pricing documentation. Be clear that the classification is okay and substantiated, but aside from this, you don't get extra credit in writing 50 pages or in providing all sorts of complementary documents to the auditor, and he really has no let's say no cause in requesting supplementary information for all eternity. You have to stake your claim, say, okay, this is the story. I have complied with the documentation requirements. This is the basis for your audit. Please conduct the audit in the fashion that you are supposed to conduct it. And I think sometimes you just have to come out and then say this very clearly to the auditor in order to save yourself some trouble and time. Yeah.
And that's the reason that we work together so nicely. I think we are like, that's just, as you said in the beginning, solution orientated and defense, and not bother our clients with something that is unnecessary to do so. Okay, so thank you all for supporting for this support, for this also the participants for their time that they now were with us. So thank you, and also Tom and Oliver would like to see you in Eindhoven or in Berlin soon. When, that would be great. And maybe not. I think this was part of our webinars. We had a couple of those, and maybe we'll get some in the coming months.
Yes. So also the people, there are a lot of questions during this session, and we have tried to answer them as much as possible. For the questions we haven't answered, we will come back to that on later on after the webinar. So in the upcoming months, we will continue with some interesting webinars. I think each 3-4 weeks we will organize a webinar, starting in August with introduction to transfer pricing. So if you are interested in one of the webinars, you can send a short email to Quantera Global Academy at quanteraglobal.com.
Yeah, and because we believe in sharing knowledge, we started a couple of years ago with the Quantera Global Academy, with also face-to-face meetings in our we call our boardroom here in our main office in Waal in Eindhoven. So I hope that it will start again sometimes, but this is also a way to share knowledge. And thank you all.